Good morning, everyone. This is Maureen Lutkins, Vice President of Underwriters Marketing Service, as well as Life Department Manager. We welcome all of you to the 1-hour virtual CE with One America. A couple of housekeeping items. This CE presentation is intended for insurance professionals and advisors only. CE credits are available in the state of Florida, Maryland, New Jersey, and Pennsylvania. If you have not sent us your license number, please do so. I'm going to type my email address into the chat box and ask you to send me your license number if you are in attendance now. We are recording this session and all lines have been muted. If you do not wish to participate in a recorded session, this would be your opportunity to exit the call. I would like to take this opportunity to welcome and introduce to you our President and CEO of Underwriters Marketing Service, Marianne Lacey Gray. Marianne?
Thank you, Maureen, and hello, everyone. We're so glad to have you join us for yet another exciting program. We are celebrating our 36th anniversary here at Underwriters Marketing Service. Where has the time gone by? But seriously, we've seen a lot of change over those years. We've seen a lot of great opportunities. Like you, we are flexible. In any sales opportunities that come your way. We are holistic here at UMS. Not sure what prompted me to do that 36 years ago, but we are a resource for all protective products, life insurance, long-term care, disability, annuities, of course, in the fixed arena, premium finance, literally everything that you might need to go in and hopefully do a review, both individually and, of course, for business owners. That's really the purpose of our discussion today, is to open some ideas for you on getting a little bit more active, or perhaps another choice for you if you already are in the business marketplace, and particularly small business markets are a hallmark here at UMS, I'm sure for you too. There's just more of them. The last stat I saw was 78% of American business is the smaller size business owner, entrepreneurs, etc. So I think that's probably even more so today than it was before with our COVID experience. And I think you'll find that with all the opportunities of owners looking for new hire, desperate to find work, desperate to really re-engage and get their businesses off the ground now that we can, even here in New Jersey, which has been one of the slowest states to respond to opening up again. But again, we're national. We can help you in any direction. Eric Pete is on with us this morning. He's our instructor for our CE and educator in this area. And of course, has tremendous experience. We've had a great working relationship with Eric and, of course, One America. This niche area, as we call it, that gets into ancillary products for group life and disability. You'll hear a little bit more from him on this, but it's a great tool. It's a great way to approach and prospect. It's a great way to enhance what you're already doing with a business owner. And obviously, the stream of income that comes from this goes without saying. It's another plus for you as an advisor or producer to get engaged and get involved. Between our support and the personal support and pledge from Eric to help you every step of the way, I'm really anxious to introduce him. Eric, welcome on our call. So glad to have you, at least meet virtually a lot of the great UMS producers. Thanks, Eric.
Thank you so much this morning for allowing me to speak and do the 1-hour CE. And I apologize, we are still working remote and my dog just heard the UPS truck drive down the street. So I apologize for that in advance. But again, thank you so much. And really today, we're going to be going over the understanding of group life plans and taxation implications that you should be looking out for, or for some of your group clients. Keep in mind that we are not tax consultants. You really need to touch base with your CPAs or your client CPAs. But this gives you a good overview of everything that we're going to touch on today. And if there's anything that you need along the way, just throw it in the chat, and we will go ahead and make sure that we address that for you. So what we're going to cover, we're going to talk about the structures of group term life policies, key provisions that group policies have in them, and then dealing with different taxation that can come into play when it comes to term, dependent, or voluntary. Okay. Your typical plan structure. Most group life policies are employer paid, meaning they're non-contributory, which means that the coverage is provided on an employer paid basis. The group term life policies usually have a matching accidental death and dismemberment benefit. So if there was a benefit out there that everyone was getting a flat $25,000 of coverage, the most common out there in the market, you'll have $25,000 benefit for the employee for life, and an additional $25,000 for any form of accidental death or dismemberment. Again, these are just the most common when you look at the stats out there. Benefit designs, they can vary and really be all over the place, but your very typical plan for an eligible employee could be a flat a benefit. So when you look at the flat benefit amounts, the most common really when we see on a flat benefit amount could be $25,000. Plans can also be set up to provide a multiple of earnings. So you might get a class, or the whole entire group might be 1 times earnings, 2 times earnings with a maximum benefit level. It could be 50, 100, 250. Again, based upon the group, the size, and the parameters, these are items that have a lot of flexibility within them. Amounts in excess of $50,000 benefits are likely have tax implications, which we will cover later, and what they call Section 79. Don't fret about that. It's just something that's out there as a norm. And there's a lot of information. If you just Google Section 79, there's tables and everything else that you need that you can find on that as well. Benefits by class. Now, this is really important because employers are able to offer different benefit levels based upon the employee by classification. And this is a great way to be able to differentiate the benefits that are offered. And the main thing that you really want to do here is that you can do so in a way that is viewed as non-discriminatory. And there's many different examples of that. An example would be, you could say all employees earning in excess of $50,000. That's a very defined class. It's non-discriminatory. It's set exactly what you're trying, who the classification is. They could have a benefit level that's different than those that make less than. You can have the same benefit across the board. So there's many different ways to do that. If you're ever trying to figure out a program and want to make sure that it's in line from an ERISA guideline standpoint, and that it is, so it's not, that it falls in line, you're not discriminating, you can always feel free to reach out to me and or your UMS team. Also, when it comes to group policies, the majority of group policies on a group basis have a reduction schedule in the program, and it typically reduces or begins to reduce at age 65. Now that can vary. There's not a set reduction schedule out there, but most of them start at age 65. As an example, benefits reduce to 65% at age 65. They reduce to 50%, and that's of the original face amount at age 70. And then another example, they could be that they reduce to 25% at 75. The other common one that you'll see out there is a 50% reduction at age 70, and that is it. Again, these can vary based upon the group's need and also the risk, overall risk and exposure that the insurance carrier is willing to provide. Coverage during disability, which is referred to as waiver of premium. You know, when you're selling individual policies, how important it is to have a waiver of premium provision. Most group term policies have this provision, and it works very similar to the individual side. If you're deemed disabled and the medical supports that you're deemed totally disabled, there's an elimination period, which we're going to touch on in a second. But once you satisfy those criteria, you know, the premium will then be waived up to a certain period of time if it needs to be requalified. Again, this is called waiver of premium. It's a wonderful benefit because those that become disabled and are totally disabled, the first thing that a lot of times people cut is anything that costs them money. And the last thing you want to do is to drop life insurance when you have a medical condition going on. Having waiver of premium is really important to have because it will help you continue that coverage. The importance of it. Waiver of premium is an extremely important provision. In many cases, if an employee qualifies for waiver, they are very likely uninsurable for individual life products due to medical conditions. So the ability to keep group term life products with no premium payment is often critical for the disabled employee. Qualifying for waiver of premium. As I mentioned before, most policies stipulate that the employee must be totally disabled from any occupation, and most policies require that total disability employees, in order to be eligible, have to be totally disabled prior to age 60. So people will ask the question, well, what happens if you have somebody that's an active full-time employee? Because, you know, years and years ago, people used to retire at 60, 65. People are working much longer. Because most of them are working because they still have a desire and love to do it. Others because they have to continue just to make ends meet. So if you do have an individual, as an example, who became totally disabled, God forbid someone was in a car accident, was totally disabled at the age of 35, and in their current contract, they had life waiver of premium, they have a $50,000 life benefit. If that individual is deemed totally disabled, met the elimination period, and they continue to be disabled, the likelihood is their benefit could continue to age 65, if not a little bit longer, with no premiums ever having to be paid during that time period. Again, it's a wonderful benefit. If you're over the age of, I'm going to take a step back here. If you're over the age of 60 and you become disabled, and again, it's typical that you have to be disabled either prior to age 60 or 65, depending on how you set up the contract. That's the most common from an industry perspective. But if you're over that age and become disabled, so let's say the contract said you had to be disabled prior to age 60. If you became disabled at age 62, you would have continuation within your contract. And the continuation typically is anywhere from 6 months to a year, but premiums would need to be paid to the employer on a premium paying basis for up to the time period that's specified in that contract. Again, it can be as little as 6, it could be 12, 24 months, but the contract would dictate that. And then at that time, the person would have the right to convert. So it'd be very expensive, but that's the other option they have if you're over the age of the required age for waiver of premium. With regard to the elimination period, which I mentioned, if the employee is totally disabled and under the specified age, most policies require that an elimination period will need to be satisfied. And it's usually 6 or 9 months, meaning that premiums have to continue to be paid. And at the end of that 6 or 9 month period, provided the medical supports the disability and that you're totally disabled and the other criteria have been met, waiver of premium would begin. Another really important item that if you're selling and soliciting and have a client that has group life, there's a lot of benefits to having the group life carrier and the group long-term disability carrier together, because long-term disability also has waiver of premium on it on a group chassis. So if you have a long-term disability program and they have a 180-day elimination period, once they become disabled at that point and are receiving benefits, a lot of that can be coordinated with your life waiver on the life side of things. So it's really good to have those two for the ease of administration. It's a much better, claimant experience when they're coordinated with the same vendor. Then once approval comes, once a total disabled employee under age 60 satisfies the elimination and is approved, premium payments would no longer be required. And again, it's really just understanding the difference in your elimination period within your contract. And there's typically no price differential, whether you have a 6, 9, or 12-month waiver of premium. One thing I would mention is that when it comes to different durations on waiver of premium over the years, we're going to touch base now on the waiver of premium duration. A lot of carriers have different options out there. The norm years ago used to be if you became disabled prior to age 60, it would go to age 65 or 70. That's the max duration that the waiver of premium would last. There are policies nowadays that might have a limited waiver duration. And what that means is if you become disabled, it may only be a 3-year waiver of premium duration or a 5-year. Those will have a direct impact on pricing, meaning a lower price because it's a lesser risk from an insurance standpoint. And the other item is that even though you're deemed totally disabled and approved, most policies do periodically require on an annual basis to satisfy the just updated medical may be required just to ensure that the individual is still disabled. Insurance carriers can include a variety of durations that we had talked about. It can go anywhere from 1 year to age 70. The most common are, age 65 or what they call Social Security full retirement age. Years ago, the normal retirement age used to be 65, but the Social Security full retirement age can be the greater of Social Security or normal retirement. Depending on when you're born, your retirement age could be 65, it could be 67. So that's why they say full retirement age. And just be sure to note the language is included in the proposals you're receiving, just because it's a super important benefit that a lot of people don't spend a lot of time on, but when you need it, it's super, super important. This is something to also keep in mind, waiver of premium. So, you look at the incurred claim. If somebody is currently on waiver of premium, that the disabled employee who is approved for waiver of premium, they will remain covered by the carrier that was in force at the time of disability. So an employee, as an example, is covered by ABC insurance for term life benefits and eventually qualifies for waiver of premium. The employer later changes carriers, as if they change carriers, say to get a lower price point, that disabled employee's coverage will remain with the first carrier, the ABC carrier, ABC insurance. So they would not move over to the new carrier. However, if the individual does return to full-time active employment, once they do, that employee will go ahead and once they meet the qualifications, they'll go on the as a full-time active employee again. They would go to the new carrier. If they remain disabled, they would stay underneath the prior carrier. Continuity of coverage when changing carriers. This comes up quite often, and the biggest item out there is you really want to understand from the carrier and their representative on how do they have continuity of coverage in their group contract. Because if an employee is not actively at work, all group life carriers on a group life basis have an actively at work statement. If an employee is not actively at work due to a medical condition, whether it's FML, whatever it might be, there's certain provisions and determination that need to be done to ensure that that employee does not fall through the cracks due to change in carrier. And the steps are very clear. They're very simple. There was a couple forms that need to be completed, but it is super important to make sure that your policyholders are doing the right steps on behalf of their employees. So if there should be a claim, there'd be a very clear designation onto where that needs to go in terms of the carrier that will handle that specific claim. Also, things to keep in mind, review the continuity of coverage scenarios to determine what carrier is liable, like we talked about. This will cover the items if someone's on an approved leave of absence. As an example, if you're on an approved leave of absence, but you're taking care of a family member, a loved one, those are scenarios in which the carrier will typically go ahead and say that person's not disabled. Thank you for letting us know. Just let us know when they come back full time. Here's how it will be handled. But you also want to say, if someone is disabled with the prior carrier, this is just a really good time to make sure that everybody is accounted for, and from a cleanup standpoint, what needs to be done for any employees that are not actively at work. Here are just a couple of different scenarios. An employee who is disabled and not eligible for waiver of premium with the prior carrier. In that type of scenario, who is disabled and not eligible for waiver of premium, there's a couple things that need to be done. If they're not eligible for waiver of premium, they should go ahead and really talk to the current carrier. If they're not benefit eligible for waiver, they could have the right to convert their coverage under the other carrier. There's some other scenarios based upon the specifics that you can go into detail. And again, all these can be worked out prior to, just to ensure that nobody falls through the cracks. You have a lot of times that you get an employee who is disabled and eligible, but failed to satisfy the waiver of premium filing requirement. Insurance carriers have a specific time that employees must submit the waiver of premium from a timing standpoint. If it exceeds that timing, unfortunately, that's just a contractual provision that if they exceed it, they typically wouldn't be benefit eligible for waiver of premium. I always let people know that, the fiduciary responsibility is of the employer, but if the employer provides coverage to the employees and the employees have a certificate available to them, they do need to make sure that they're doing things timely in terms of filing some of these things. You also have scenarios where an employee that we talked about initially, someone who's taking care of a loved one who is absent from work due to a non-medical event. Those types of scenarios, the carrier that's replacing the other carrier will typically look at that and say, look, it's a non-disabling, non-medical related. They're taking care of somebody. That's one that they usually, the carrier will accommodate and let you know what needs to be done there. Retiree life benefits. So when it comes to retiree life benefits, years ago, there's a lot of older policies that have retiree benefits. There's certain types of industry that you see, retiree benefits on as well. But what transpires over time, when you do have retiree benefits, they typically end up supplementing the active rate on the group. So an example, if you have a, I can give you a live example. We were just working on an account the other day. It was a 400-person group, and they had about 15% of the group were retirees. When we looked at the pricing component of it, the active group, the full-time active employees, had a 19-cent life rate. That's per thousand of benefit. When you added in the retiree coverage, which was a very small percentage, but they're older, the likelihood of those being paid out is much higher. It was 15% of the population, and I think 10% of the volume. And they drove the rate per thousand up to 50 cents. And it was solely because of the retiree population. And again, they weren't super rich benefits. It was just, we know that those are going to come. It's just a matter of when from a claim perspective. And so it's one of those things to really look at when groups say, well, we think we want to add a retiree benefit. First off, you need to make sure that the risk can be accounted for in that group. And then you need to also think about the long-term ramifications of the cost of that program, because over time, it gets very costly when you continue retirees on a program. In the example that I just gave you, showing you the true cost for actives versus the retirees and what they do to the overall pricing and risk. And accidental death and dismemberment is typically not even offered to the retiree classes. Some other provisions that are really important within the group life contract is the accelerated life benefit. You guys are familiar with that in terms of individual policies as well. But this is a benefit that is available that if somebody is diagnosed with an illness that has a life expectancy of typically 12 months or less, that they can get a percentage of the group life benefit, and that can be paid out earlier. And then when the insured does pass, the additional amount would still be paid out on behalf of that, and provided everything within the contract is met. But it really helps out in some hardship. We've seen many different times that people want to utilize it for financial reasons, or if they wanted to take a trip with the family. These are just rough times, and you just want to make sure that you are utilizing and maximizing the benefit provisions that are truly there within the contract. Some of the other key provisions within the accelerated life benefit is the life expectancy that I just mentioned. This can only be exercised if they have a limited life expectancy. It's typically 12 months. Some can be more restrictive. And the benefit percentage amount, meaning the amount of the benefit that is eligible for the life expectancy, the accelerated life benefit, would be stipulated in the contract, and it can vary. You see some as low as 50, some go up to 80%. So that's just the way that those work, and some have flexibility that you can pick a percentage up to a certain level. Again, these are great provisions to have if you truly, an insured is in this situation. But it's good to let the policyholders be aware, because a lot of policyholders aren't aware that those provisions are, within the contract. Voluntary life. So what we just talked about was all employer paid. Voluntary life is just, employers offering a program to employees as well as spouse and or children. It's a voluntary basis. The employee pays 100% of that cost. And it's just really, in light of the pandemic, voluntary life and life within themselves have been very, very popular. The costs are based upon age, so they're age banded. They're typically 5-year age bands. That's how the cost is derived. And the smoking status from years ago, there used to be smoker, non-smoker rates. A lot of employers are leaning towards just doing what they call a UNA rate, which is a blended rate between smoking and non-smoking for ease of administration. Again, this is a payroll deduction program, and employees can usually obtain the specified amount of coverage, on a guarantee issue basis. So when we offer voluntary life coverage for the first time, there will be a guarantee issue amount, meaning no medical questions are required, provided that the insured is benefit eligible and actively at work on the effective date of the coverage that's supposed to be effective and implemented. And it will be guarantee issue for the employee, a guarantee issue amount for the spouse, as well as the children. And that can vary based upon case size. But again, there will be an element of that will have no medical questions required. If there are amounts that go over and above, you can go ahead and increase your benefit, but that will typically require medical questions to be answered, which is very common. But a couple advantages to your voluntary life: it's extremely affordable, it's payroll deducted, so it's super easy for the employee to be able to see the value that they can get additional coverage for themselves and their family on a payroll deducted mode. The guarantee issue that we talked about, spouse coverage as well as child coverage. The coverage is also portable, meaning that if you're under a certain age, and it varies by state, but if you're an employee who is working and bought voluntary life coverage, and then for some reason you're leaving or you're retiring, and let's say that you are under age 70. So let's say you're 60 years old and you're leaving the organization because you're going to retire. Some carriers still allow you, even though you're retiring, to port the coverage if you're under a certain age. Other carriers don't, but if you're leaving to go work somewhere else and you're not retiring, you are able to go ahead and port the coverage or convert it. That's your choice. When you port coverage, it's portable, that goes to term rates. When you convert it, that goes to a whole life rate. Therefore, it will be it'll be more expensive, but then you do accrue, cash values and some of those other advantages with a whole life plan. The coverage usually includes waiver of premium, but again, it's based upon the carrier and how the contract was set up. And again, some also will have matching AD&D, the accidental death and dismemberment, but again, that's how the contract is set up. Voluntary life coverages is typically in increments, and it could be, that you can offer it in $10,000 increments up to a maximum of, it could be 200, 300, 500,000 of coverage. Spouses can get increments, an example of 500 to 5,000, and that can be either capped at 50% of what the employee elected, or it can be 100%. So you could have a program that you have that has a $250,000 maximum. You can purchase it at a minimum of 10 in $10,000 increments, and the spouse would be subject to 100% of what the employee elects. Some will say 50%. And again, some of this is based upon how the State Department of Insurance, when we filed, has certain requirements out there. So it's all based upon state filings. But if you have any questions again on that, when you're submitting a request for a proposal, you can always feel free to ask. Spouse coverage is usually limited, like we had just mentioned, to a percentage of the employee election. It can go up to 100%. The spouse rates and pricing can be based on the spouse age or the employee age. It depends on the carrier and what the policyholder is able, from an administrative end, handle. But generally, carriers require that in order for a spouse to be able to be to elect coverage, that the employee must elect coverage as well, and that's pretty common. Child coverage varies by carrier, but generally it's up to $10,000. It's usually a unit cost, and those are just some things that you need to check with the carrier on how they price their programs. So if you had 6 children, depending on the carrier, and there was a $10,000 unit cost of $2 a month, whether you had 1 child or 6 children, it would still be the $2 total, and they would each have a benefit level of $10,000. Again, you need to check that to make sure the carrier on if they're doing it, if it's per unit or if they view it for each child. Then voluntary whole life. Over the years, it's been back and forth, back and forth. There are still a lot of organizations that offer voluntary whole life in the market. It's just a much more expensive product. It does accrue your normal whole life. You can do payroll deductions. But again, it seems, when you look at the stats out there in the workplace, more employers are offering voluntary term life solely for the cost, the guarantee issue components of it. And then if there's individuals who have a need for a greater or more permanent plan, that's typically when the employer will refer them to the consultant who has the other lines of coverage to be able to see any other needs that that person might have for a whole life policy. Why whole life? Again, there's advantages to the whole life plan. The term policies are typically a working benefit. For the employees of working age. Most voluntary term policies terminate when they say this terminated age 65 or 70. Some of the updates, our voluntary term policies from an industry perspective do continue. They will have some form of reduction at 65 or 70, but they typically go up through age 99 or 100. It would be costly still there, but they could continue on a term basis. The advantages of whole life, again, is that it's a post-retirement option. Many of whole life policies, and this is what you all do every day, they can build cash value, they may pay dividends, and they also allow employees to borrow. There's just a lot of advantages to a whole life plan. It really is based upon the need of the insured. Unlike term policies, many carriers allow employees to select coverage based upon a payroll deduction, which could be a lot less. It's an example for $5 a week on whole life, you'll get X amount of coverage that you can buy. So it's a little reverse when you're doing term insurance. If you wanted a $50,000 policy or a $50,000 benefit, it will tell you what the cost is for that $50,000 benefit. So definitely a little bit of reverse there. The amount of coverage available, it depends on age, gender, smoking status. It can be an excellent product for those who desire post-retirement insurance coverage. And some carriers allow coverage on a simplified issue offering without true medical underwriting. But again, it's typically not as high. There's certain participation requirements there. So just some different things to look at. Okay, with regard to understanding group term taxation, again, this is something that you should refer to your CPA or the group CPA if they have specific questions. But you should always be considering this when designing group ancillary group programs. While many employers are aware of taxation on group disability products, in many cases, they are unfamiliar with the fact that there's any type of taxation or could be for basic term life, dependent life, as well as voluntary products. As a starting point, we just want to be really clear that, the IRS has determined that group life benefits are non-taxable to the beneficiary. However, for group policies, employers must still be aware of tax regulations that apply to basic term life, dependent life, and voluntary life. Section 79 is that the IRS set regulations in Section 79 of the Internal Revenue Code that address the potential tax of group term life policies. We're going to go a high-level overview of this, and it really only applies to the group term life. It does not apply to whole life, travel, accident, and dismemberment type policies. It allows employers to offer $50,000 of basic or employer paid term life coverage without any tax consequences. Any amount in excess of $50,000 are subject to income tax. So think of it as imputed income. For amounts in excess of $50,000, employers must calculate the amount of imputed income, which is typically added to the employee's W-2 at year end. When you're looking at this, the factors that come in, there's a grid and a table, which we're going to show. Let me just flip to that to make it a lot easier. So this is the grid. This is, the IRS grid that's shown out there to calculate and determine any type of imputed income. And employers nowadays, they've been doing it for years. A lot of employees might not even notice it, but the employer will let them know about it, that it's shown in the W-2. A lot of the payroll vendors take care of this for them. And again, it's on the employer paid coverages. So the way that this works, you need to determine the amount in excess of $50,000. Very simple step-by-step here. Divide by 1,000. And these are not things that you need to do. Again, this is on an employer level. And if they're offering group life today, they should very well be aware of it. But again, it's only the amounts in excess of $50,000. So you divide by 1,000, determine the employee's age, and then you just walk through how this is done. So this assumes a simple calculation. This is a benefit that's being offered by a company of $100,000, and they're a 40-year-old. So obviously they indicate anything over 50,000. So you take the 100,000 benefit minus the 50,000 equals 50,000 will be the amount that you want to look at in terms of the imputed income. 50,000 divided by 1,000 is 50. You go back to the table, and on the table, you get a 40-year-old is a 10-cent rate. It's $5 a month or $60 per year. So $60 would need to be added to the employee's W-2 at year end, in which the employee would then, pay the tax on that $60. Again, get in touch with your CPA, but a lot of the payroll vendors handle this and take care of this on behalf of the employers, provided the employers are sharing that with them. Or if no one wants to deal with it, you go and do a 50,000 max benefit. So you might see that sometimes on cases. Many employers may not be aware that dependent life benefits are also potentially subject. If there's a dependent life plan that's in the basic life program, so any amounts in excess of 2,000 could also will also be subject to the imputed income. But you don't see many dependent life riders on basic life like you used to in years past. But it would follow the exact same that you had done previously. Voluntary term policies are also subject to Section 79, but nearly all voluntary plans contain age-banded rates. So the one thing that you can look at is they call the Straddle Roll. So you remember those rates that we showed back on this slide. So if all of the age-banded voluntary rates are either at these rates or below, option one, or they're either at these rates or above, then you're not straddling, which means that you have met the the Section 79 guidelines here. So as long as all rates for all ages are at the same or lower, or as long as all rates are at the same or higher, then there's no tax consequences. Sometimes consultants will, do what they call the straddle test for the employer and let them know. And then if there are some that are up or down, they can make that adjustment to it. Voluntary term life rates that straddle. Some voluntary plans have rates that cross over or straddle table 1. That is some of the rates that are above or below, like we had talked about. In this instance, the rates that are below table 1 require imputed income to be reported for the entire amount of the voluntary benefit that has been elected. Again, these are things that you can test it very easily. It sounds somewhat complex. It's just not, and there's very quick solutions for this that the employer has to determine if they're okay with changing some of the rates. You have to also get back to the carrier and have the carrier involved to see what they can accommodate as well. Auditing voluntary life rates. It is important to review voluntary life rates that are being offered by the insurance company and carriers. When developing proposals, many insurance carriers will simply match in-force rates using rates without auditing for Table 1 compliance. If you find that the rates straddle Table 1, you can notify the group. Like we had just talked about, the group may want to change the rates to comply to Table 1 at the next policy anniversary and notify the employees of the change rather than be burdened with the responsibility of imputed income and administration. That's what employers will typically look to do just to make it simpler for everybody. Section 79 summary, provide your clients with an understanding of the Section 79 and Table 1 rates when assisting them in designing the basic term life, dependent life, and voluntary policies. Be sure the voluntary rates provided to your client carriers do not straddle the Table 1 rates, and be sure groups understand the rules regarding this. And that's why they have you. You can come in and discuss this and just make it very simple for them and set it up the right way the first time. Key employee benefit eligibility test. This is something that's designed to determine if your plan favors, key employees, because that could be viewed, as, discriminatory. So a plan is discriminatory if it cannot pass at least one of these tests. The plan benefits 70% of all employees. At least 85% of all participants are not considered key employees. Again, these are just some things to consider when you're looking at different plans that you're going to be offering to key employees. When you're looking at key employees, they may not be allowed the $50,000 exemption. Section 79 does not allow plans to favor key employees in terms of eligibility. If the plan discriminates in favor of key employees, the value of the entire amount of insurance provided by the employer becomes taxable for key employees only. And the main purpose of these types of things is that, putting in a program just to benefit key employees are obviously not favored, because the benefits, there should be equality across the benefits being offered to all. And that's why being able to write individual policies, those are items that a lot of times people use the true individual policies in addition to the group, so they can keep everything in compliance. When you look to say who is a key employee is any employee who at any time during the plan is 5% owner, an employee owning more than 1% interest in the company, and whose compensation or income from the employers exceeds $150,000 per year. It can be an officer of the employer whose compensation exceeds a certain income level. And then the other items here, it can be plans that cover non-discriminatory class of employees as determined by the IRS. And if the plan is offered under a cafeteria plan, the cafeteria plan must satisfy the non-discriminatory requirements of Section 125. You know, when you look at all of these types of items and the items that we just talked about, there is a this does get complex when you start digging in to trying to satisfy a certain population of employees. But a lot of times, if you just offer, you know, benefits up to $50,000, and you're not discriminating between the classes, there's a lot of ways that you can make it a very simple plan. Section 79 also states that the group life plans cannot favor key employees in coverage types or amounts. The plan will automatically pass if you provide the same flat benefit to all employees. You base the benefit a percentage of income and use the same percentage for all employees. So an example, 25, 50, $10,000, you can offer one benefit for all. And then the other way is you could offer a 1 or 2 times salary is what they're saying, to a maximum of 100,000, or if you want to cap it at 50, whatever you want to do, that would be non-discriminatory. Even if the plan doesn't provide the same coverage amount for all employees, the plan is not automatically considered discriminatory, and the plan simply cannot favor key employees as defined in the other slides. So we are right at 12:22. I know there was a lot there, but I appreciate everybody's time and be glad to open it up to any questions. And I'd be glad to answer anything. If someone can read off the items in the chat, I'd be glad to answer those.
Okay, thank you, Eric. It's Maureen again. Yeah, there's a few questions here, and I want to also mention that quite a few positive comments here, and I'm sure folks will think of some things after they hang up. And if so, of course, just give us a call, 800-524-1774. But one question, Eric, is with reference to slide 16, which once the question was posted, I just couldn't remember what was on slide 16.
I'm going back. I'm going back.
I wanted to know what the EP, waiver of EP, I believe, or perhaps they meant waiver of premium.
No, okay.
Was elimination period mentioned there? Let me take a look.
Yeah, no, it says EP, so that's the elimination period.
Okay. All right, thank you. Okay. Changes seen through the pandemic. What have you noticed since One America is obviously, clearly in this marketplace? What have you seen as changes through the COVID situation in the employer world?
I mean, the main item, and that's a great question. A lot of people have been revamping their basic life programs to increase, even on an employer paid basis. We've seen many companies and organizations out there that have enhanced the basic life that's being offered, not only on an employer paid basis, but we've also seen many companies that thought about offering voluntary life in the past, now offering it and getting really, you know, above average participation. And unfortunately with the pandemic, everybody was touched or knew some loved one or knew somebody that was impacted by a death due to COVID and not thought that it would ever happen to them. So it raised a big awareness on the life insurance side.
Right, it sure did. With all of us, absolutely. One of the questions that sort of, I think, spun off from that thought is, if someone already had, regardless of the employer, regardless of the insurance company, if someone already has a voluntary, employer paid maybe and voluntary program in place, and they're interested in adding, you know, a third level, I guess the possibility exists to have it be taxable in that if it's not paid by the employee. Is that true? If the employee pays 100% of the premium on an additional plan,
and so
$50,000 rule for the employer, right?
Right. And so, yeah, and it's really depending on, it needs to follow, because we're not allowed to be tax consultants on this, but it does, if it follows the table one and it's not straddling, on a voluntary basis, if they're purchasing it, they're typically, so if it's not straddling, then they typically should be good to go, unless there's something outside the norm there. Other than that, they would be responsible for some form of the imputed income, which the employer should be providing to that employee,
Right.
on behalf of that.
Now, I have worked with you and your team there for a couple of years now. Can I presume that if we bring a case to you, you and your group will help us help the producers walk through and iron out, the possibilities of what they already have in place, what they may need to put in place, and how it may impact the employer? Is true?
Yeah, that is true. And what we will do is we will let them know, because it mentioned in one of the slides in that, a lot of times if we're taking over a voluntary life plan that's age banded, most of the carriers will go ahead and match what they have in force today, because that's just the way they have it up. And they will mention that, this is straddling, which means that you need to adjust, there's something that you need to adjust these couple of rates. Some employers choose not to change it, but you can notify them and let them know, because they should really make that change, but that's totally up to them, and they'll have to deal with how they handle that from the imputed income standpoint. But we will be able to show you if it's straddling or not straddling. Absolutely.
Okay, but it is possible to add to, not just replace, but add to already existing plans, or no?
You
Well,
can. And typically on the employer paid side of it, there's some carriers out there, the medical carriers in the markets do sometimes require a basic life plan of 25,000, 15,000 or something. Or if they have a policy in force, just let us know and we'll connect with our underwriters, and typically to be able to put an additional benefit, because there's a lesser benefit there on the employer side and they need to keep it with that carrier, we can add on from there. That typically is not an issue.
Okay, thank you. I want to point out, as you hear Eric just reeling this information off the top of his head, how critical it is, unless you're in this business yourself, if you're adding this to your portfolio to help what you probably are helping your business clients anyway with other things, why not have someone on your team, on your side, to speak with your client whenever necessary and really help to get these programs enrolled properly. It always amazes me, Eric, that you're just so accommodating in that area.
Absolutely.
Yeah, go
Oh,
ahead.
I was just going to add to that, if there's any time, we really are extremely consultative. You can just tell us the situation, the solution, what you're looking for. We'll come to you with some solutions. And it doesn't mean we have to provide a quote. We can help you out and jump on the line with you or a client, just give us, ample notice, and we'll be glad to do that for you.
All right, thank you. We do really appreciate it. All right, one last question before I let you go at this point. Many slides back, I don't have the slide number. What were the ages or the max age of dependents who could be added to voluntary programs?
That's a great question. I don't think we talked about that in here, believe it or not, but that was a great question. So typically, and again, it's state specific, for the most part, you get your dependent children. So there's two sides. So the spouse is typically to age 70. That's the most common. You can do it though, that it follows the employee. So if the employee is full-time active, we can eliminate the age 70 requirement for spouse, but that's very common from an industry perspective too, that spouse is up to the age of 70. At the age of 70, they would have the right to convert within 31 days if they wanted to a whole life policy. That's the choice there. And then with dependent children, some people want to age 26, regardless of student status. Some states, might have to age 19, or to age 24 through age 24. or to age 26 based upon student status, and some is state specific. But that's the ballpark on the child end of it. The specific quote though, and the in-force policy, if you're sending one in or looking at one, will have that outlined. And then the quote will also outline the max age for spouse and or children on the quotes themselves.
Okay, that's good. Yeah, that's good. Yeah, that is a good question. Medical insurance tends to roll with the 26 on the younger people for children. So it's good.
Yep.
Yeah, good to know that it's probably similar.
No, it's very similar, and it's just depending on, we don't have to abide, the life insurance companies have some different requirements on the dependent status when it comes to children, the to age 26, when that came out years ago. So it's just a matter of, what's the preference on the life insurance side, and then working with the vendor you're utilizing for your life coverages.
Right, right. All right, we would like to have Mary Ann join us again for one closing comment. Mary Ann? Mary Ann, we can't hear you. You need to activate your mic.
Okay, is that better?
Yes.
Yes.
Good. Thank you, Maureen, and thank you, Eric. I just wanted to let the audience know that obviously the first place to go is your existing files and client access that you already have for this good opportunity. But I want you to know that in addition to education and backroom support here at UMS, we also have business owner lead program information for those of you that want to prospect a little heavier in a certain targeted industry or geographic area, etc. So again, please reach out to us at 800-524-1774 and ask Maureen, Trudy, myself, for any of us. We can give you more information on that.
Thank you, Mary Ann. Yes, amen to that. Please contact us anytime, and you will be hearing from Tori McKiernan, most likely in the life department, and follow up. Eric, I can't thank you enough for continuing to do all that you do for us and for everyone. And thank you to everyone for joining us today. We'll be in touch.